Financial markets often appear chaotic, yet beneath the surface a profound order governs their movements. For centuries, astute observers have sought to decipher these hidden rhythms, transforming mere speculation into a rigorous professional endeavor. Among the most enigmatic and influential figures in this quest was William Gann, a legendary trader whose methods, while complex, offer a unique lens through which to view market dynamics. Gann believed that time, as much as price, dictates market direction, and that by mastering temporal cycles, traders could anticipate significant turning points with remarkable accuracy. This video will explore 6 fundamental rules developed by William Gann, principles designed to help traders understand the deeper mechanics of market movements and leverage this knowledge for more precise forecasting, ultimately elevating their trading from a gamble to a disciplined profession. These rules delve into the very fabric of market behavior, offering a systematic approach to identifying patterns and predicting future price action, providing a robust framework for those committed to professional trading. The first of Gann's foundational principles is the law of vibration, a concept central to his entire philosophy. At its core, this rule posits that financial markets do not move randomly, but rather operate under specific, discernible vibrations and cycles. These vibrations, according to Gann, are not merely arbitrary price fluctuations, but rather inherent rhythmic patterns that can be identified, understood, and subsequently utilized for predictive analysis. A deeper analysis reveals that Gann's concept of vibration extends far beyond simple price oscillations. It encompasses both price and time, suggesting that these two dimensions interact to create harmonious or dissonant relationships within the market. When these elements align harmoniously, they can signal periods of stability or sustained trends. When they are dissonant, they often precede periods of increased volatility or sharp reversals. Practical application of this rule involves diligently searching for recurring patterns in both time and price. This could mean observing how certain price levels are retested after specific time intervals, or how a market reacts after a particular number of trading sessions. For instance, a commodity might consistently find support at a certain price level every 90 days, or a stock might experience a strong upward thrust after consolidating for a fixed number of weeks. Identifying these repetitive patterns, these vibrations, can provide powerful signals for potential market reversals or accelerations. Some expert traders and analysts who study Gann's work interpret this law as a means of pinpointing energetic points within the market. These are junctures where the accumulated force of prior price and time movements reaches a critical mass, making a change in trend highly probable. They believe that by tuning into these underlying frequencies, one can sense shifts in market momentum before they become overtly obvious. However, it is crucial to acknowledge the inherent challenges and criticisms associated with the law of vibration. One of the primary counterarguments is the subjective nature of interpreting these vibrations. Unlike many conventional technical indicators that offer clear, quantifiable metrics, the law of vibration often lacks universal, easily measurable parameters for unambiguous definition. Its application frequently demands a significant amount of experience, intuition, and a profound understanding of Gann's broader methodologies, making it less accessible for novice traders. Moreover, the absence of standardized tools for directly measuring these vibrations means that different practitioners might arrive at different conclusions, highlighting the need for extensive personal study and chart work to truly grasp and apply this elusive yet powerful principle effectively. The true mastery of this law lies in developing a keen eye for subtle market rhythms that escape superficial observation, requiring a dedication to deep analytical practice. The second pivotal rule in William Gann's framework is the rule of squaring of time and price, which highlights the profound symmetry underlying market movements. The essence of this principle is that significant market reversals or accelerations frequently occur when price and time achieve specific symmetrical relationships, often referred to as squaring. This concept suggests that there is a fundamental balance in the market where the magnitude of a price movement can be intrinsically linked to the duration of that movement. To delve deeper, squaring implies a harmonious correspondence between a market's vertical price and horizontal time dimensions. For example, a market might rise 100 points over 100 days or fall 50 points over 50 weeks. In such instances, the market is said to have squared itself, and these points of equilibrium are often identified by Gann as critical junctures where the prevailing trend is highly likely to reverse or undergo a significant acceleration. The practical application of this rule involves sophisticated methods of constructing charts that visually represent these squaring relationships. Traders might use specialized charting techniques or Gann's own square of 9 or Gann wheel to identify potential price levels and corresponding time windows for a change in market direction. These tools allow practitioners to project future price targets or time-based turning points by looking for instances where a specific price level aligns numerically or geometrically with a particular time frame. For instance, if a market has advanced 200 points from a low, a trader might look for a reversal around the 200-day mark from that low, or at a price level that is geometrically related to 200 on a Gann wheel. The visual representation offered by these tools helps to make these abstract concepts more tangible. For example, the square of 9 is a spiral number chart where numbers are arranged in a spiral pattern, and specific relationships between these numbers, e.g., numbers along diagonals or cardinal cross lines, are used to project price and time points. When price reaches a certain level, one can look at the corresponding numbers on the square to identify potential time targets or vice versa. However, applying this rule comes with its own set of challenges. One of the most significant difficulties lies in correctly scaling charts to accurately reflect the intricate relationship between price and time. Without proper scaling, the symmetrical relationships that Gann identified can be distorted, leading to incorrect interpretations. The choice of the correct unit for both price and time is paramount and often requires considerable experience and calibration. For instance, determining whether a point in price should correspond to a day, week, or month in time is a critical decision that significantly impacts the validity of the squaring analysis. This demands a nuanced understanding of the specific market being analyzed and a careful selection of the appropriate time frames and price units to ensure that the visual representation accurately reflects the underlying market dynamics. The third rule, William Gann's rule of Gann angles, introduces a geometrical dimension to trend analysis, portraying market movements as trajectories along specific angular lines. The core idea is that price, in its progression, adheres to certain geometric angles that function as dynamic lines of support and resistance. These angles, when properly drawn, represent the ongoing balance between the passage of time and the movement of price. A deeper analysis into Gann angles reveals the paramount importance of the 1-by-1 angle, also known as the 45-degree angle. This angle symbolizes an ideal equilibrium where price advances 1 unit for every 1 unit of time. It represents a perfectly balanced trend. When price moves along the 1-by-1 angle, it indicates a strong, sustainable trend. Other angles, such as 2x1, price moves 2 units for 1 unit of time, or 1x2, price moves 1 unit for 2 units of time, signify either stronger or weaker trends, respectively. A 2-by-1 angle being steeper than 1-by-1 indicates a faster price increase relative to time, suggesting a more aggressive uptrend. Conversely, a 1-by-2 angle, being flatter, indicates a slower price increase, denoting a weaker uptrend or a stronger downtrend if applied in reverse. Practical application of Gann angles involves constructing Gann fans from significant market vertices or troughs. By identifying a major high or low point, a series of angles is drawn from this origin, projecting into the future. These angular lines then serve as prospective levels of support and resistance. Traders can observe how price interacts with these angles. Staying above an ascending angle signals trend strength, while breaking below it often indicates a weakening trend or an impending reversal. Experts in Gann analysis frequently observe that the penetration of certain key angles can act as a powerful signal for a shift in the prevailing trend. For example, if price consistently trades above a 1-by-1 angle, it confirms the strength of an uptrend. However, If it breaks decisively below the 1 by 1 angle and then below a 2 by 1 angle, it suggests a significant loss of bullish momentum and potentially the start of a downtrend. The interaction of price with these angular lines provides visual cues about the market's underlying energy and direction. Despite their utility, Gann angles are not without their challenges. A significant counterargument centers on the subjectivity involved in selecting the initial point from which to draw these angles. The choice of a significant high or low can vary among traders, leading to different angular projections and interpretations. Furthermore, the necessity for constant calibration means that as the market evolves, these angles might need to be redrawn or adjusted to maintain their relevance. The correct scaling of the chart, as with the squaring of time and price, is also critical for the accuracy of Gann angles. An improperly scaled chart will distort the angles, rendering them ineffective. Therefore, mastering Gann angles requires not just an understanding of the geometry, but also a refined sense of market context and continuous adjustment to the dynamic nature of price action, making it a skill honed through considerable practice and observation. The fourth rule in William Gann's sophisticated methodology emphasizes the importance of specific time cycles, serving as a powerful tool for forecasting market reversals. This principle asserts that markets frequently demonstrate significant turning points, whether reversals or accelerations, at certain predictable temporal intervals. These are not random occurrences, but rather cyclical phenomena that can be anticipated by those who understand Gann's framework. A deeper analysis into this rule reveals Gann's focus on several key temporal cycles, often expressed in terms of days, weeks, or months. Intervals such as 90, 180, 270, and 360 units, e.g., days, weeks, or months, are considered particularly significant for market changes. These numbers are not arbitrary. They are often derived from divisions of a full circle, 360 degrees, reflecting Gann's belief in the cyclical and geometric nature of time. For instance, 90 days represents a quarter of a year, 180 days a half, and 360 days a full year, all points that Gann believed held special significance for market turning points. The practical application of this rule involves meticulously counting these cycles from significant historical market highs or lows. By identifying a major peak or trough, a trader would then project forward in time by 90, 180, 270, or 360 units to identify future potential points of reversal. For example, if a major market low occurred on January 1st, a trader might anticipate a potential turning point around April 1st, 90 days later, July 1st, 180 days later, or October 1st, 270 days later, and then again around the following January 1st, 360 days later. These dates serve as time windows where the probability of a shift in market direction is heightened. Furthermore, Gann's method sometimes incorporated calendar dates and astronomical cycles, not in an astrological sense, but purely as objective temporal markers. For instance, equinoxes and solstices, which mark specific points in the Earth's orbit, were sometimes noted as periods when market sentiment or volatility might shift. These are viewed as natural temporal divisions that can influence collective human psychology and, consequently, market behavior. The emphasis here is on the cyclical nature of time itself as a determinant of market rhythm. While direct statistical validation for the precise efficacy of these exact cycles might not be universally accepted in academic finance, it is notable that many experienced Gann practitioners and dedicated traders empirically observe an increased likelihood of market changes during these specific periods. They often report that markets tend to turn or experience intensified volatility around these projected timeframes, suggesting that while not a guarantee, these cycles offer a valuable probabilistic edge. The strength of this rule lies in its ability to provide a future-oriented framework, allowing traders to prepare for potential shifts rather than merely reacting to past price action. It transforms the often reactive nature of trading into a more proactive, anticipatory discipline, enabling a trader to align their strategy with the market's inherent temporal pulse. As we delve deeper into Gann's intricate world, it becomes clear that his methods extend beyond simple observation, embracing complex mathematical models. The fifth rule, the rule of numeric structures for forecasting, highlights the use of specialized numerical frameworks like the square of 9 or the cardinal cross to project future price and time points with astonishing precision. This rule underscores Gann's belief in the inherent mathematical order of the universe, which he saw reflected in financial markets. At its core, this principle involves understanding the construction and function of instruments such as the square of 9. This is a spiral grid of numbers, typically starting with 1 in the center and spiraling outwards, where each number represents a potential level of support, resistance, or a crucial reversal point. The genius of the square of 9 lies in its ability to relate numbers geometrically. Numbers that fall along specific diagonal lines or cardinal cross lines, horizontal and vertical through the center, are believed to have strong vibrational relationships. For instance, numbers along the same diagonal might represent potential price targets or time counts from a significant market turning point. The practical application of these tools involves a process of calibration. A trader would input a current significant market price, e.g., a major high or low, into the square of 9. From this anchor point, the tool can then be used to identify subsequent important price levels and corresponding time intervals where a market might experience a turn. For example, if a stock is trading at 100, one might locate 100 on the square of 9 and then observe the numbers that fall along its key diagonals or cardinal lines to project future support/resistance levels or potential dates for a reversal. These numerical relationships provide a roadmap for anticipating market behavior. Expert practitioners often regard these numerical structures as exceptionally powerful for uncovering hidden mathematical connections within the market. They believe that these tools tap into a deeper underlying order that influences collective human psychology and, consequently, market movements. The precision offered by these methods, when applied correctly, can provide traders with a distinct edge in pinpointing critical market junctures that traditional technical analysis might overlook. However, it is essential to address the criticisms and challenges associated with these highly specialized methods. A common critique is that Gann's methods, particularly these numerical structures, lack scientific grounding and are often considered speculative by mainstream financial academia. Their predictive power, while anecdotally supported by some practitioners, is not easily validated through conventional empirical research. Furthermore, the complexity of mastering and correctly interpreting these instruments presents a significant barrier for newcomers. The square of 9 and cardinal cross are not intuitive. They require extensive study, practice, and a deep understanding of Gann's intricate scaling and calibration rules. Without proper guidance and experience, a novice might find these tools overwhelming and difficult to apply effectively, leading to frustration and potentially erroneous conclusions. This means that while powerful, these tools demand a dedicated commitment to learning and a willingness to embrace a non-conventional approach to market analysis, making them a domain primarily for serious students of Gann's work. While these rules offer a powerful framework for understanding market dynamics, truly mastering them often requires delving into the original source material. Here, William Gann himself provides unparalleled insight into the very principles we're discussing. His classic work, Truth of the Stock Tape, is an invaluable resource for understanding market cycles and the psychology of speculation directly from the master. Although the original charts in the book might be of varying quality due to their age, the textual wisdom within is absolutely priceless, offering foundational knowledge that remains profoundly relevant today for anyone serious about professional trading. You can find a link to this essential read in the description below to deepen your understanding and connect directly with Gann's original teachings. The sixth and final rule in William Gann's comprehensive framework for market analysis is the rule of cause and effect, a principle that views the market as a dynamic system of accumulated energy. At its core, this rule posits that the magnitude of a market movement, which is the effect, is directly proportional to the amount of time and price accumulation, or cause, that preceded it. This is a fundamental law of physics applied to market behavior, suggesting that nothing happens without an underlying reason that builds up over time. A deeper analysis into this law reveals that Gann considered the market to be a system where periods of consolidation, slow movement, or range-bound trading represent the accumulation of cause. During these phases, energy is being built up, demand and supply are reaching equilibrium, and the market is preparing for its next significant move. This accumulated cause then leads to a corresponding effect, which manifests as an explosive trend, a sharp reversal, or a substantial market rally or decline. Conversely, a prolonged and significant trending move, a large effect, will eventually exhaust the underlying cause, leading to a period of consolidation or reversal as new cause begins to accumulate. The practical application of this rule involves a meticulous analysis of the duration and amplitude of previous market movements and consolidation phases. Traders analyze how long a market has been consolidating and within what price range. A longer period of consolidation within a tight range, for instance, suggests a greater accumulation of cause, implying that the subsequent effect, the breakout or breakdown, is likely to be more significant in terms of both price magnitude and duration. Conversely, a short, shallow consolidation might lead to a less powerful subsequent move. This rule essentially teaches traders to measure the potential energy of the market. The connection between this rule and Gann's broader emphasis on time cycles is profound. Longer periods of cause accumulation often correlate with larger, more significant time cycles. For example, a multi-month or multi-year period of consolidation, a large cause, is more likely to lead to a major long-term trend, a substantial effect, that aligns with broader temporal cycles rather than just a short-term fluctuation. This means that by identifying and measuring these longer accumulation phases, traders can anticipate more significant sustained trend movements. Practical recommendations stemming from this rule include the critical task of identifying phases of accumulation and distribution on price charts. Accumulation phases, where institutions and smart money are quietly buying, represent the building of bullish cause. Distribution phases, where they are selling, represent the building of bearish cause. Recognizing these phases is key to applying the rule of cause and effect, as it allows traders to position themselves ahead of the market's next major effect. This rule underscores the idea that patience during consolidation periods is rewarded with powerful trend participation, emphasizing that understanding the underlying energy dynamics is as crucial as pinpointing exact entry and exit points. Integrating these 6 rules of William Gann into a cohesive trading strategy is where the true mastery of time cycles for professional trading emerges. The synergy of these methods allows for the creation of more robust and reliable trading signals, moving beyond the limitations of any single indicator to provide a comprehensive analysis of market dynamics. For instance, a trader might identify a potential turning point using the rule of specific time cycles, such as a 90-day cycle from a significant low. This temporal window could then be cross-referenced with the rule of squaring of time and price, looking for a price level that squares with the elapsed time. Further confirmation could come from observing how price interacts with Gann angles during this period, perhaps holding above a key 1-by-1 angle, suggesting continued strength, or breaking below it, signaling a reversal. Finally, the rule of cause and effect would be used to assess the potential magnitude of the anticipated move, based on the preceding accumulation phase. By combining these layers of analysis, a trader builds a multifaceted argument for a high-probability trade setup, significantly increasing confidence in their decisions. Crucially, even with the sophisticated predictive power offered by Gann's methods, effective risk management remains an absolutely vital component of any professional trading strategy. No predictive method, regardless of its accuracy, can guarantee 100% success. Markets are dynamic and subject to unforeseen events. Therefore, proper capital allocation, setting appropriate stop-loss orders, and understanding position sizing are non-negotiable elements that protect trading capital and ensure long-term viability. Gann's rules provide the edge in forecasting, but robust risk management provides the resilience to navigate inevitable market uncertainties. Furthermore, discipline and patience are indispensable virtues for any trader employing Gann's principles. The market does not always adhere to precise mathematical or temporal schedules. There will be instances where signals are ambiguous, or where expected turning points are delayed. The professional trader must possess the discipline to strictly adhere to their trading plan, patiently awaiting clear confirmations from the market rather than blindly chasing every potential signal. Overtrading based on incomplete or weak signals or deviating from a well-defined strategy can quickly erode capital, regardless of the underlying analytical framework. Finally, the journey to mastering William Gann's methods is one of continuous learning and dedicated practice. These are not tools that can be superficially understood and immediately applied. They demand deep study, extensive backtesting, and practical application over time to develop the necessary intuition and skill. The nuances of chart scaling, the subtleties of identifying true vibrations, and the precise calibration of numerical structures all require significant effort. Professional traders committed to this path understand that it is an ongoing process of refinement, where each market observation and trade contributes to a deeper understanding of Gann's timeless principles. In conclusion, William Gann's 6 rules, the law of vibration, the squaring of time and price, Gann angles, the importance of specific time cycles, numeric structures for forecasting, and the rule of cause and effect, offer a profound and systematic approach to understanding financial markets. By embracing these principles, traders can transition from a speculative mindset to a disciplined professional methodology. The mastery of time cycles provides traders with a unique and powerful advantage in deciphering and predicting market movements, allowing them to anticipate shifts rather than merely reacting to them. This framework, while demanding, empowers traders to see the underlying order in what often appears to be chaos. We strongly encourage a dedicated and in-depth study combined with consistent practical application of these principles. For those willing to invest the time and effort, Gann's methods offer a pathway to achieving more consistent and stable results in the challenging yet rewarding world of financial trading, transforming the art of speculation into a true profession built on insight and foresight. The journey is challenging, but the rewards for those who master these cycles are immeasurable, providing a distinct edge in navigating the complexities of the global financial landscape. The journey to becoming a professional trader is continuous, and while Gann offers one powerful lens, diverse perspectives can further refine your edge. Another foundational figure, Richard Wyckoff, developed a distinct yet equally profound methodology for market analysis. His adapted work, How I Trade and Invest in Stocks and Bonds, provides a comprehensive look at his systematic approach to identifying market phases, understanding supply and demand, and making informed trading decisions. It's an excellent complement to Gann's time-based insights, offering robust strategies for market structure and price action. Explore Wyckoff's timeless strategies via the link in the description to broaden your trading arsenal and further solidify your analytical framework.